Morning Wealth Press subscribers, viewers, traders, and investors. Welcome to yet another Monday morning roundtable. This week, I'm joined by Adam Sarhan, Jeff Yasteen, Roger Scott, and Jeff Zandaneri. Gentlemen, how are we all?
Excellent.
Great, thank you.
I'm good.
Excellent. Roger, let's kick it off with you. I happen to know that you've been conducting surveillance on the F-13 filings at the SEC over the weekend. What did you learn?
You make that sound extremely espionage-esque, very...
Well, surveillance, research.
I love it. I love it. Hey, I'm not complaining. Yes, every quarter, large funds file a form with the SEC and the federal government to disclose their holdings. It is called the 13F form. And I wanted to go through the top holdings. What I do is I look at the top hedge funds, not in terms of dollar size, but in terms of the fastest growing funds from the previous quarter. And I match up their top 5 to 10 holdings. And if I see a pattern there, in other words, I want to see the fastest funds hold the same position. I want to see a pattern in that position. So there's really, from last quarter to this quarter, I mean, there's, you'll always find Amazon, Microsoft, Facebook, PayPal. Those are no-brainers. But let me talk about a few stocks that are on this list that I am new to and have not been on this list before. And that's where the money is, actually. For example, last quarter, you may or may not remember, I gave a stock, C Limited, SE. Yep. No one knew what it was about. Everybody was thinking, why would this stock go up? And the stock exploded. So these are the same type of stocks. These stocks have something in common. They have a large holding of funds. So to get into it, to start off, the first one is Vroom, and the ticker symbol for Vroom is VRM. All right, and it's a used car dealer. That's what they are. They're a used car dealer. Used cars are going crazy. Carvana right now is going through the roof. There's a lot of money in used cars because people are refinancing their homes, taking money out of mortgages, and buying. Buying is hot. Consumer discretionary, Adam and I were talking last week, is hot. Retail sales is now already making a comeback past where we were a year ago. So used car market is hot. The next one is CoStar Group, ticker symbol CSGP. It's a commercial real estate network. And it's really surprising that this company is being bought up, but it's being bought up. And I'm not going to argue with the largest hedge funds who are, and I mean more than 5 are buying the stock up. The next one is, and there's only a few here. The next one is Pinduoduo. Yes, Pinduoduo. Ticker symbol PDD. And the company's about to replace NetApp in the NASDAQ 100. So that is really, really big. And those are the 3. Oh, another one. The last one is StoneCo. StoneCo, and that is and Warren Buffett actually has a small share in it. It's a Brazilian e-commerce company that's about to match up with Square Pay, PayPal, and Stripe. Mm-hmm. And we know how hot those processors are. So, and the ticker symbol there for StoneCo is STNE. So we got StoneCo, Vroom, Pinduoduo, I hope I'm pronouncing it right, and CoStar Group. And okay, we have a substantial number of meaningful hedge funds accumulating those stocks over the last 45 days.
Interesting. All right, Adam, now you've been looking at retail earnings this weekend. What have you learned?
So we have a lot of stocks coming up this week that are reporting earnings. Home Depot, we have Walmart, both Home Depot, Walmart tomorrow, so on and so forth. And retail sales in general, we saw on Friday, came in below expectations, were up. And retail, the consumer spending is 2/3 of the economy. So if we have these retailers blow out numbers and report, record numbers, that's great, because that would suggest that the trend is going to continue and the recovery is on pace to continue to help both Main Street and then transfer over to Wall Street. Now, if we see the opposite happen, where these big retailers and just in general consumer spending is soft for any reason, that doesn't bode well for the consumer or Main Street or Wall Street. So really, I want to see two things. I want to see the numbers themselves, how they compare to the same period last year, and also I want to see the reaction to the numbers, because that, like Roger just pointed out, is what the big institutions are doing with their money. Forget their opinions and what they say on TV. What really matters for me is what are they doing? What are they buying and what are they selling? So if you see these retail stocks report numbers, even if they're lousy numbers, but they gap up or they go up on price, that would be very bullish, because that would tell you that the big institutions are in there aggressively buying.
Mm-hmm. All right. And Jeff Yasteen, how does that correlate with what you've been looking at?
Yeah, it correlates very, very well. And there's one position I like. It's Five Below. They're basically let's say a Dollar Tree geared more towards teenagers and kids, college students, that sort of thing. The average price in the store is somewhere between $5 and $10. They have a really great formula. That stock is still not, it's ascended somewhat. It's up like 50, 60% from where it was March lows and for the broader market. But like this year, they're going to earn $1.54. But next year, their earnings jump up to like $3.60 a share. So this is an example of a growth stock, a retailer, a bricks and mortar retailer with some e-commerce mixed into it. But there's a lot of these out there that have sort of been forgotten because they're not tech for tech's sake. And yet there's a really good fundamental reason to buy them if you're looking out a year or so. And for some, like Five Below, it's been hovering right at or just below its 200-day moving average for a while now.
Interesting. Okay, so retail seems to be on the mend. Headline that we saw just at the tail end of last week was that Warren Buffett had started to lighten up on his beloved bank stocks, and against all expectation had actually started to accumulate Barrick gold, which he has always been mildly contemptuous of the idea of investing in gold, at least that I've ever heard. And so, Jeff Zandinieri, what does that portend for the market and for Barrick and for, by extension, other gold asset classes like juniors and ETFs?
So it confirms two things that I already knew. Number one, Warren Buffett likes making money. Number two, there's a lot of value traps out there because this guy's sitting on a boatload of cash and he likes nothing more than to buy cheap stocks, buy, what people view as classically cheap based on their PE, based on their book value. And he can't find anything to do that in. So am I surprised that he sold the banks? A lot of people sold the banks. He also sold the airlines not so well. I'm not going to hold that against Warren. He has an amazing track record. The bigger tell is that he can't find anything by his classical cheap metrics to buy, to invest in. And so he's getting outside of his comfort zone. And he knows that he knows that we're in an inflationary environment. He knows that currency is being debased. He knows that hard assets are going to go up. So he's forced to buy gold.
Mm-hmm. So, but his choice of Barrick, of all of the major gold producers, when you look at a senior gold producer, two primary fundamentals need to be considered, and that is your average cost of acquisition per ounce in the ground and your average all-in cost to produce that ounce. And Barrick, by all metrics, is probably the worst gold company in the world. So do you think that him stepping out of his comfort zone, he's now just defaulted to some of his sort of pet indicators, like he's chosen the biggest and the most best known brand in gold miners?
Well, something to consider with Warren is he needs to move size. He's a size player. So like a lot of, those metrics that you mentioned, you're absolutely right on. But like anything, they're not a nimble player anymore, right? So they've diluted their own business plan, so to speak. But for Buffett, it's a matter of how much of this can I buy? And when I start to buy, I'm not done buying. This is the beginning of his buying. So I think of it like that. And he likes to obviously affect what the company's doing, et cetera, et cetera. So I think it's more of a case of like, he's probably got 5 gold companies in the world that he can buy. You understand what I'm saying? Like,
yeah, absolutely.
That are big enough to handle a Warren investment. And so
Right.
he has to operate under those restrictions.
Let me ask something, in fact, because I don't follow Barrick, but are they much like Newmont in that the dividend payout is geared towards the price of gold?
Don't know.
Anybody know that? I guess what I'm saying here is that for Buffett buying this, it may not be so much, capital appreciation buying, the best of the best. And I think what Jeff said as far as buying size is key here as well. But the other part is, if the dividend is geared towards the price of gold, which is like what Newmont went to a few years ago when gold was much cheaper, it's like a free cash ticket, presuming continued demonetization of the currency. And so, it's just like an easy free ride on that, whether the stock itself is particularly, treasured by, gold investors particularly. The other thing I'm just going to point out is, we all forget Buffett bought silver in bulk in, I think, 1997 when it was really, really cheap. And I didn't realize this till the other day because I was surprised about the news on Friday. But in the 60s, he stated in like a Berkshire Hathaway shareholder letter at some point years ago that in the 60s he had been buying silver again in the sort of devaluing of the currency at that time. So in some ways it is a huge surprise that he did this. On the other hand, he follows the trends. And he's not going to leave these sorts of opportunities to go away. We saw that with him shifting to buying Apple a few years ago. So,
Sure. Well, I can say with relative authority that Barrick Gold's dividend is certainly affected by the gold price in that its dividend is derived from free cash flow. The fourth quarter of 2019, they raised their dividend substantially based on the profit of 1.4 billion that they made as a result of the rising gold price. So is the process determined by the gold price directly? No, but is it affected by the outcome of the gold price on their profit? Absolutely. So I would say that's the case. Okay, so
if I may interject just very, very quickly, Jeff, just to respond to your specific question, Barrick does not have as much of a dividend as Newmont. It's in a slightly different class. If I had to guess, and this is only a guess, Newmont, in my opinion, the reason why he specifically chose that company is because it's got a better value perspective right now, and also to Jeff's point, it definitely has the size. But if I was a value investor in gold, that would probably be the closest company to still having that most value that hasn't been brought up by momentum levels, that still shows some of the qualities that he's historically looking at. But again, it's not as much of a momentum play as Newmont has been. Newmont has been top on relative strength in the last 6 weeks, top 10. This one has not. So it is more in line with what he has been doing historically, and because it's a cheaper stock in terms of a value play, I think that's what's attracting him more into it.
Mm-hmm. Interestingly, but the reason I believe that Barrick is lagging in terms of value is because of their track record over the last. Look at the last gold cycle; they made some really bad decisions. They had to take I think it was a $7 billion write down in their Pascua-Lama project, which straddles the border between Italy and Chile, because trying to get a mine built with two different unions in two different countries in Latin America is pretty much akin to Russian roulette. It's just a matter of time.
Exactly. Right.
James,
so I think
Italy and Chile.
Sorry, Chile and Argentina. Did I say Italy?
I heard Italy.
Maybe my fault. I misspoke. It's Argentina and Chile, definitely not Italy.
Big border.
Boy, the world has really changed if that's the case. Okay, so I guess we can all concur that gold remains a asset class of interest going into this year, just based on the currency debasement going on, and we see retail recovering, and the funds are making moves into different companies that sort of support those theses. So again, I want to sort of bring it back to now for the individual investor sitting at home with perhaps a windfall based on their success at listening to us week after week, they're wondering, okay, what specifically do I buy this week? We've had some good ideas, but is there anything that we're missing? And Jeff Zananira, I'm going to start with you.
I mean, I've been playing this listen, last week we had this, the world is ending in tech. The sky is falling and gold is going back to zero because we had distribution day and we had a counter trend sector rotation. And so I did not view it as a change of the pattern, but as just a risk off type of situation. I don't know how you can be bullish the market and bearish on the market leaders. I mean, all the classic technical training that I have is that if the internals of the market change and the market leaders start to really have destructive moves on their charts, you should be really worried about the broader market. That's to say that, and then I got confirmation of this on Friday, and Roger and I talked about it last week after we had the discussion on this show. And then I had confirmation with Warren. It's not so much what he did, but what he didn't do. So what I would say for this week is if Warren isn't out there buying casinos, buying hotels, you shouldn't be either. This guy has an extreme experience in sniffing out what a value trap is. And sometimes just because a stock has gone down a lot, it can still be expensive. And that's my thesis, is that a lot of these companies are being supported by the broader bid in the market. They're living off of that liquidity and off of that bid in the market. So I expect a blow off top in tech, which means you're going to get a super boost bid in the NASDAQ. Goldman this week came out and raised their guidance on the S&P projections, largely on the back of a continuation of that move. And so I'm still long gold, and I'm still long the high flyers because I think that's what's going to lead us. And I'm not bearish. I'm just not bearish. I think we've gotten a lot of bad news, and we've taken a lot of the bad news. I will turn bearish when I see good news happen and bad price action.
Mm-hmm. Okay. And Jeff Yasteen, what are you thinking for the week?
What Jeff said, I'll repeat as far as, the trend is great. And if you're into tech and those sorts of things, it's worked. And I think it'll continue to work for at least for another 3 weeks here. I think we're a lot closer to the end than the middle of things. But stay with what works until it doesn't. I mean, clearly. But in the meantime, I think people should be looking at places and sectors that they can rotate into. I think retail is one. And despite what Buffett did or didn't do regarding banks, I think banks are a place to look at. I think he still has a huge position in Bank of America, even though he lightened up on some of the others. And I think there's a lot of interesting plays amongst those. But if you went into them now, it's going to be dead money for a while.
Mm-hmm. Okay, Adam, how do you correlate all this with what you're thinking for this week?
Sure. I think this week specifically, I want to see how the retail stocks perform. I also like looking at undervalued and growth areas of the market. And for me, healthcare and biotechs are just a screaming, please look at me. The neon lights and all that fun stuff are right there. Zosana Pharmaceuticals, a stock I mentioned a few weeks ago on the show that helps headaches, is up 60%. The IBB, which is an ETF that tracks biotechs, is sitting really nicely, basing nicely for the technicians out there. The healthcare ETF, XLV, is just perched near its all-time highs, moving sideways as it consolidates a big move. And once we get this cure or vaccine or whatever, please God, somebody comes to just get life back to normal, it's going to come from the healthcare space and the biotech space specifically. And then I could see a really just big, huge move up, irrespective of anything that's going on, once we get definitive, clear, thumbs up, cure, vaccine, what have you, from that space. So that group, to me, or the healthcare and biotech groups specifically, are both good areas to put money into work.
Sure. Roger, there's a real sort of separation in the marketplace of people who think that there's going to be a vaccine and it's going to be this year and we can start to wind down our fears about the coronavirus. And then we've got the world data that is indicating under no uncertain terms, led by the United States, that the virus rate of infection itself is increasing, and we're not even at flu season yet. And so is this a threat to the future of the market? in the near term, if the virus continues to explode, are we at risk of seeing another economic shutdown?
We are. I realistically speaking, I don't know if we're going to have it. The likes of us having it are higher if Democrats take the election, but I think we'll see a resolution before that. But here's the thing, James, regardless of how you look at it, no matter how you cut it or slice it, it's not going to be a V-bounce recovery that's just going to go down and up and everything's going to be fine, hunky-dory, life comes back to normal. As me and Jeff have talked about this, you and I have talked about this, certain people are not going to respond to the vaccine, even when it comes out. Certain people are going to have certain reactions from the vaccine. Certain parts of the world are not going to have the vaccine. They're not going to be able to afford it, not going to get it for political, whatever the reasons are. The point of the matter is, this road that we're going to move on to is not going to be an instant snap your fingers, let's move ahead, everything is hunky-dory. I think we're in for a turbulent ride. And I think the fact that the Fed is throwing, and central banks recognize that and throwing so much cash and money into it is really, really helping us out. But at the same time, you're starting to see defensive assets move up as well. So I don't think there's going to be a one easy, simple solution. I think it's going to be part of the economy. I think it's going to become a smaller and smaller part as time goes on. But I think it's going to stay with us for a lot longer than people think. I think it's going to stay with us for a few years, even, but to a smaller extent, to a smaller degree. It's like when something bad happens to a person, they'll still remember it 5 years later, but the reaction's not going to be as great. I think the market is going to continue assimilating it into its price action. So I don't think it's going to be I don't think it's going to be binary. I don't think it's going to be zeros and ones. I think it's going to be a little mix of everything, which is how usually society and nature progress. It's usually 2 steps forward, 1 step back, and so forth and so forth and so forth. So I believe that's kind of what we're going to see. So I think thinking too far ahead can be very dangerous right now. And I think we have to stick with where we are at right now and play the market. And that's been working very, very well. And I think that's going to continue working. For example, the broad market is getting a lot broader. If you were to look at the S&P 500, top 50 stocks were all tech, cloud stocks, and medical stocks about 2-3 months ago. Things are different, as Adam has pointed out. Retail stocks, there are several retail stocks. Gap, Haineswear, L Brands. They were nowhere near the top 50. They are now in the top 10. Home builders, companies like Whirlpool, basic material, paint stocks. So what I'm seeing right now is the world is becoming less focused on COVID-19, but it's still keeping it very much on alert. And I think that's going to continue. It's just going to become a smaller part of the problem over time. It's not going to be yay or nay. It's going to have its hiccups and it's going to have its flare-ups, so to speak, over the next couple of years. And but it's not going to be the main market driver. If things work out the way we and I think Pfizer and I think a few other companies will have a good vaccine in place. But again, it's not going to be the end of this. I think the problems that it's created over the last 6-7 months are going to stick with us for the next couple of years. It's just going to get smaller and smaller. And I think that's the healthiest way to look at it and the most realistic way to look at it as a retail investor.
Okay. Gentlemen, let's leave it there for this week. We'll come back to you again during the week individually and next week for the roundtable. Thank you very much for your time. Have a great week.